Welcome to the Treasury Update podcast presented by Strategic Treasurer, your source for interesting Treasury news, analysis, and insights in your car, at the gym, or wherever you decide to tune in. On this episode of the podcast, special host Meredith Zonsius interviews the author of The Strategic Treasurer, a partnership for corporate growth, Craig Jeffery, on Wirecard. They discuss what led to this event, were there early warning signs, and what Treasury groups and the C-suite should learn from this situation. Listen in to this crucial conversation to learn more. Wirecard made financial and international news recently in a rather concerning manner. Through an audit, it was uncovered that 1.9 billion euro, which is 2.1 billion US dollars, was missing and then determined to have never existed. This led to a rapid drop in the company's valuation, the CEO's resignation, and then arrest. Welcome to the show, Craig.
Thanks for having me, Meredith.
The news on Wirecard was not isolated to business outlets. It made international news. Give us a thumbnail overview of the timeline.
Sure. There's a shortened view of the disastrous week for Wirecard, where everything was discovered or much was discovered and rolled out. So on the 18th of June, 2020, an announcement was made about the missing funds. The missing funds totaled about 1.9 billion euro, which is 2.1 billion USD equivalent. This created a large market cap drop. So the price went from 104.5 euro to 39.9 euro, which was a 60% loss thereabouts in the market cap and the price and the market cap. Market cap dropped from 12.9 billion. It lost about 8 billion euro by the close and was under 5 billion at that point in time. So that one day from the 17th to the 18th, they lost about 8 billion euro in market cap. On the 19th, the next day, Marcus Braun, the CEO, resigned. A few days later, after the weekend, on the 22nd, Marcus Braun, the CEO, was arrested on market manipulation charges, and the stock closed at 14.44 euro, and the market cap on the 22nd ended the day at a little less than 2 billion euro. 25th of June, Wirecard filed for insolvency protection. Their market cap now sits, or at the time of this recording and at those dates, sits under 1 billion euro. So from almost 13 billion euro valuation to under a billion, they lost more than 12 billion in market cap in that time frame.
Wow, this is quite the week. You mentioned shortened view. That implies there's a longer view. Can you expand on that?
Yeah, there certainly is a longer view. So this is the week when everything unwound for Wirecard, or much of it unwound for the company in terms of this publication, this discovery of what went on. The longer view includes a couple factors that I think is worth noting. One has to do with short sellers. There was quite a bit of negative view on Wirecard that things weren't right. There's short sellers who've been working on their stock price for a long time, betting against the firm, some for as long as a decade, continually losing as Wirecard's value continued to increase, and some of them kept betting against it for years, even as much as a decade. So that's one of the backstory, that there's indication and some people that have done analysis that said this can't be the case. They're betting against it in a big dip. That was one. The second had to do with the Financial Times. That's the big financial paper. It's like the Wall Street Journal in Europe. Previously had accused Wirecard of round tripping. These are what's sometimes referred to as lazy Susans. It's selling and buying back the same or similar assets. So sending money back and forth, treating it as revenue when it's really, there's no value added. You're just moving money through the organization, but it provides some transactional base apparently to record revenue. And so this can create that appearance of robust growth, strong activity, but there's no financial profit or substance. So the longer view is this has obviously been happening for a longer time. And there were some indications out there, but from an audit perspective, that wasn't discovered until really just recently. They were able to avoid that in 2019 by KPMG at that time, and E&Y wouldn't certify their financial statements, and that's when that came to light. So the auditor on the main account, their headquarters in Germany, went through this process and wouldn't certify, and this is where everything unwound.
What do we know now?
Well, this is an ongoing investigation, so we need to be careful about saying we know everything, but we hear, and there's good reason to believe, that the financial statements were falsified in two primary ways, and there may be more. We'll be eager to listen to what's going on and what gets uncovered in the unfolding months. But one, from an income statement perspective, inflation of revenue numbers, this round-tripping charge by the Financial Times certainly seems to bear more scrutiny. So that's one aspect, of what's going on. The second has to do with the balance sheet. About 2 billion euro was falsified. 1.9 billion euro of balances were non-existent. That made up about half of their balance sheet at the time, if I remember correctly. So those are pretty significant items, both income statement, balance sheet items, and we know that this has occurred at other times as well, where there's this type of activity that gets hidden from the auditors. It's not disclosed.
This would surely imply collusion. How can that be defended?
Yeah, that's a good question, because I think, those who took accounting and auditing courses, there's like, oh, you can't defend against collusion is a general summary statement, because if you have multiple people working together, you can defeat controls, whether they're controls for transactions or controls for financial reporting. And there's an element of that, but there's a couple challenges there. For collusion to work, it requires more than one person. In this case, the CEO has been charged, and we do know that the chief operating officer is also being sought, in the Philippines. So we don't know exactly what's going on there, but that's what some of the news is reporting. So we'll have to see how that plays out in terms of was there collusion, or is this done by a single person? But the other factor is, how do we defend against collusion? Is the more people that are involved, the harder it is to commit fraud. And better visibility makes it harder for collusion, because visibility means that more people will know and can point out that something is not right, especially when it's at this magnitude. 2 billion in cash is extremely significant and makes a major impact on the size of an organization. But and what I mean by that, better visibility would help eliminate some of the noise from this round tripping. This, hey, I'm sending money back and forth. I'm creating this flurry of activity which creates noise in the process. That's more difficult for people in the organization to see. Is this real? Is this hiding fraud? Is this hiding cyber fraud, external fraud, or internal fraud? And better visibility cuts through a lot of that noise that this apparent round tripping made, which made it more difficult for auditors over multiple years to validate the actual revenue. So proper bank account management processes, controls, bank account structure, can make falsifying cash balances much, much more easily detectable, much more readily detectable, both to people in finance and both to external auditors, because it would be easier to prove.
What does Treasury have to learn from this?
Yeah, so this lesson has come up, and I know you wanted to talk about other cases as well, but the concept would say Treasury has to learn that bank account management is extraordinarily vital. And I say that with the perspective of people don't take it as seriously as they should. Back from years ago when we started talking about EBAM and exchanging information electronically with their banks, people thought they were doing a pretty good job with bank account management. Then they realized, well, our stuff's on Excel files, multiple files, it's in paper files. We can't exchange things electronically based off of paper files. It needs to be put into a system and managed. But bank account management goes beyond that aspect. That was one element that I think pushed people to start to clean up their bank account management. But when we think about how do we manage our bank accounts, effectively? How do we manage our cash? What's essential for visibility, for control? We have to think about the standards of good corporate conduct. What are the minimum standards that we need? Just like an accountant would have standards for, generally accepted accounting principles that say, here are the minimum standards of what we do. Same thing for Treasury is we have to have standards of good corporate conduct. And what are some of those standards? I'm not going to list all of them, but I'll mention a few, Meredith. One is daily visibility to all accounts. If you have a bank account, it's an operating account, you should have visibility to that on the balances, on the transaction details every day. That's a cost of doing business. If you have it, you should do it. Especially when there's a lot of activity, and for large organizations, this is a intensive money transferring organization, you should have automated reconciliation, taking that detailed information, reconciling, identifying differences that can be resolved. And so automated reconciliation would be a second one. The third, and this may not be universal, but it's certainly an operating principle, is that all cash posting would be done by Treasury. And the other side, you may be handling, booking, receivables, revenue, et cetera. The operating area would handle that. And while, they're booking cash, maybe they're using a clearing account, the other operating area is hitting clearing account and then revenue, or whatever the other side of the double entry accounting is. That should be done to create that segregation of duties systematically, particularly because we have systems that can do that. That needs to be done, posted, recorded on an automated basis, by rules on a daily basis is the general principle here, especially when you're a larger organization with intensity around transactions. And finally, in terms of this short list, I would say Treasury has to do some type of internal review or validation of accounts. You might call them Treasury audits or Treasury bank account validation. This is, every 2 years you're working through your list of all your accounts. You're checking signers, balances, account controls, transaction level controls. You're doing a validation to make sure you have a complete inventory, that it's kept up to date on your records, and that the bank's records are also identified as well. This allows you to eliminate signers who have left the firm, reduces many of these points of exposures. There's usually cost benefits to it as well, but it's a way of protecting the most liquid assets of a firm and validating that. So very useful activities to do.
This isn't the first time this has happened. What are some other examples?
There's many, many examples, and some of the big examples, the billion-dollar equivalent frauds with some type of intersection to what Wirecard had done. I would mention Parmalat. This is the Italian dairy, cheese and milk company. Huge, huge organization. This was a long time ago back. It was uncovered in 2003, but the fraud occurred for like 13 years. The notable amount of their fraud was 4 billion euros in bank balances. And they had challenges on the income statement side. They were able to control the audit confirmation process, and were able to play around with the different auditors they had, being able to create noise, and were able to intercept the confirmation process and create a fraud that ended in default, bankruptcy, jail terms for the executives. Very, very significant. There's some big failures there on that front. Fast forward another 6 years, still quite a ways back, Satyam in 2009, an Indian firm created fictitious accounts, fictitious employees, and did accounting fraud. There was a lot of collusion and a lack of visibility occurring there. That fraud was around $1 billion USD equivalent. CEO did 7 years of jail time, and others had fines as well. So very, very significant items where when we think about managing our bank accounts and making sure we have visibility, this prevents some of these egregious frauds from being able to be promoted and maintained for so long, because more people would know that these numbers aren't anywhere close to what's going on. So if I want to hide things, I want to make it so people can't see what's going on. I want to create a lot of noise so it just looks confusing, and then I can buy some time. And what visibility does is it helps us know where our cash is at any moment in time. and prevents some of these distractions from actually distracting auditors, our internal organization, and more people from knowing what's going on. So it provides a lot more security. We can't just rely on this. We're going to audit things and make sure our controls will detect a fraud when it occurs, and we'll be able to recreate it. Treasury has to do more of these preventative and earlier detection activities to stop them from occurring or to prevent them from continuing as long as they can, because the natural audit function may take a lot longer than to discover something than a more rigorous bank account management structure, information reporting method, and assessment and validation would allow to occur.
Well, thanks, Craig. I mean, this has been a very crucial conversation to have, and there's been a lot of great information that you've shared today. As we come to a close, I just want to, as we celebrate our 2-year anniversary on air, I just want to extend a special thanks to our listeners for tuning in and for their continued support.
You've reached the end of another episode of the Treasury Update podcast. Be sure to follow Strategic Treasurer on LinkedIn. Just search for Strategic Treasurer. This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.